Hey guys, welcome. I am just waiting for everybody to join the stream before we jump straight in. Today's session is all about strategy development. I think last week we kind of got off on a tangent and didn't really go too much into the actual strategy development side of things. So today I'm hoping that we can kind of counteract that, take a deep dive into the metrics and statistics of what we offer at Darwin Xero and Darwinex so that you guys can take this information away and go and implement it on your own trading accounts. Now, what I usually ask is if there's anybody in the audience who wants their record to be analyzed, I will do it live. We will take a look at some of your metrics and some of the things that you do well and maybe not so well as a trader. How are we doing, Vincenzo? I see you just booked a meeting with me, so it's great to have you here. LVH, awesome. Straight away, somebody straight in there. LVH, beautiful. So if we bring up Darwinex as well, LVH. Let's go LVH. Oh. I might not like that if I haven't used it in capitals. How are we doing, Jay Sid? Hope you're all good. Hope you are good. Yeah, I don't think this is liking it without the capitals, so let's readjust that. What's it doing that for? Okay. LVH? Are you sure it's LVH? Since LVH hasn't been traded since 2021. Yeah, maybe that was a glitch because LVH wasn't loading then, which is strange. Usually it's pretty responsive. Maybe everyone's blown up their accounts, right? And the servers are just gone a bit. Oh, VLH. I was going to say LVH has been inactive for a long time. I should know that considering we've been speaking on emails, right? But I get that many Darwins come through and I analyze that many records that it's just, yeah, I just forget. I would say there's probably 20 or 30 Darwins that I remember and specifically stick in my head. All the others, the letters just get muddled up in my brain. But anyway, there's more people pouring into the session. So welcome, guys. This session is dedicated to strategy development. So what we do usually is take somebody from the audience, and we've had Vincenzo step up today and provide us with his Darwin, which is actually a classic Darwin, which I think is the first classic Darwin, maybe the first, maybe the second, I don't know. But one of the only classic Darwins that we've evaluated in these sessions. Now, the purpose of this isn't to say whether something's good, bad, or ugly. It's to take a look at the metrics from an unbiased perspective. Understand kind of what's going on behind the scenes and if there's any low-hanging fruits that we can kind of take advantage on from a trading or an improvement perspective. Sometimes it's difficult to ascertain whether there is anything to improve or anything to, kind of take a step back from. But sometimes, just sometimes, going through your statistics, especially having somebody who is a third party, unbiased, has no kind of prior knowledge or information on your trading strategy, sometimes it can bring some things to light, right? Especially coming from different variables that you perhaps wouldn't look at. Now, I'm not sure whether VLH is automated or discretionary. It looks to me like it's an automated approach, but I'm sure Vincenzo can clarify that for us just so that I know that moving through, because of course, the feedback is going to be different if you're an algorithmic trader compared to a discretionary trader. Of course, there's things that, an algo trader can implement or not implement that a discretionary trader may be able to or may not be able to. So it's an important differentiation to make. I won't ask too much about the strategy. Okay, so it's fully automated. Perfect. I was going to say, looking at the equity curve, there's not many discretionary traders who have a curve that's that stable, really. Or I shouldn't say stable, but that kind of direction in a way. Is there any, before we kind of get into it, is there any martingale or any grid elements to the strategy? And the only reason I ask that is because generally the drawdowns are pretty fast and sharp, yet kind of the gain is slower in its approach. which to me would signify that either it's gridding to a degree, martingaling, or scaling into positions, which there's nothing wrong with it. It just sometimes can come back to bite you in the rear end if the risk engine doesn't like it, if you start getting into too deep drawdowns. But if you can just clarify that before we jump in, I'll take a look at some of the variables that we have. And for the guys who, haven't been to these sessions before and know nothing about me, I've been a trader for the past 7 years almost. I was a discretionary trader for 6.5 of those 7 years. Is it 7 years? I'm pretty sure we're coming up to 7 years next year, although I've been in the markets for a few years longer than that. And for the past 6 months, I've become a full algorithmic trader. I don't really touch the markets from a discretionary perspective anymore. Before I was a trader, I was a data analyst. So this kind of thing where we're looking at metrics and different analytics is kind of what I love to do, right? It combines two of the things that I would like to say I've been quite good at throughout my career, which is data analysis and trading. I've had success in both. So, taking a look at different variables and trying to find patterns is something that I really, really enjoy doing. It's sometimes more interesting for a discretionary trader, I'll be completely honest, because usually, and this doesn't go for everybody, but usually, especially up and coming traders, like beginner traders who may be in their initial phase of learning and implementing a system into the market, they are very heavy lenient on one variable. And that usually is a technical pattern or a chart, because, that what they'll do is they'll join a mentorship or take a course that is kind of all based around this. Oh yeah, we load up the chart, we draw this pattern on. If the pattern's there, then we execute and we manage, X, Y, and Z. And generally that becomes that trader's identity, right? That's what that trader does every day. They don't deviate. That's their system, which is fine, but that will only get you so far. There's 1,000,001 different variables that you can look at when building a strategy, and when looking to, improve the strategy, or kind of even taking a step back and removing certain things that you do. A technical chart, a pattern will not always give you the full picture. It won't always give you the full story, because you can kind of put filters in there from different variables that isn't available on the chart. But anyway, I'm starting to ramble, which I do a hell of a lot, so I apologize. We're going to jump straight in. VLH, let's go. I mean, firstly, the equity curve is super impressive. Vincenzo says it's not a martingale, but it is a mix of grid system and single trade EAs, which I would have hazarded a guess at that anyway, purely because of the steep decline when it goes into drawdown. So what you'll find if we scroll down to the drawdown analysis, you'll see the drawdown doesn't last for too long, really. I mean, apart from this one, which was 74 days, which was the worst drawdown. What point was that? 2022. Okay, so this record's been since 2022. Okay, so March 2022. So that was this drawdown here. Okay, so since then, I'm presuming that you put some things in place, because that's kind of an outlier when we look at the other drawdowns. The max days that you've been in drawdown since then has been 15. Across your worst drawdowns anyway. We're not counting periods of stagnation here, but drawdowns specifically, that's kind of an outlier. So I'm presuming that you made a change after that drawdown. However, back to my point is they're all pretty steep, they're all pretty fast, and then it recovers fast. Pretty telling sign of a grid / martingale / pivoting into a strategy. I am not opposed to grid systems completely. I think used in isolation, it's pretty dangerous. Whereas I think if you have enough margin, if you have enough equity in your account, you can sort of use it to hedge against, like Vincenzo says, like single trade EAs or other trading strategies. I do it myself on one of my accounts where I have a really low risk grid system. I have a really low risk carry trade system. And then I have single trade EAs executing for me as well, which are all custom built by myself. So it's a really interesting notion, right? But you just have to be ready to cut trades when the downside gets too big. Again, I'm rambling on about, random stuff. Anyway, let's take a look. So 5 Forex cross pairs are the pairs in question. I could have guessed it would have been Aussie CAD. Aussie CAD is one of those pairs that is notorious for grid trading purely due to its mean reverting nature. They're both high beta currencies, which means generally when one is moving in one direction, the other is too. So you get these kind of mean reversion plays, even if the exotic pair kind of goes out of sync with the major pairs. Because if you aren't aware, which I'm pretty sure everybody in this session will be, the exotic pairs is just a synthetic price that is derived from the two majors. So, for example, Aussie CAD would be Aussie US versus USD CAD, and it would be a synthetic price between those two. So, if Aussie US is going up and dollar CAD is going down because they're inverted, you might see some stagnation in Aussie CAD. But if Aussie US is increasing and dollar CAD is relatively stable, you'll also see Aussie CAD increasing because it's synthetic between the two. I actually saw a funny video about this the other day, right? I'm not going to mention any names, but it made me chuckle because somebody was talking about kind of having the secret sauce on finding cross asset correlation. And they were talking about how it's a cheat code to know the correlation between euro dollar, pound dollar, and euro pound. And if one's going up, it means that euro pound's going to go up and vice versa. And I was kind of thinking, well, of course, because it is a synthetic pair derived from those two currency pairs. So that makes sense, right? If it's following both prices, of course, if euro is stronger than the pound, of course, euro pound is going to be stronger. And it was like, oh my God, I found the secret sauce. Like, this is how I find the cross asset correlation. And I was kind of sat there thinking, it's not really a cross asset correlation. It is derived from the price. Again, getting off topic here, but I felt like having a rant at the time, but I didn't get the opportunity. So I'm having a rant now and subjecting you guys to it. Okay, 75% win rate on Aussie CAD, 84 Aussie US. Classic sort of grid system. This would seem, super high win rate with a relatively low return on some of them. The majority of your return coming on Aussie CAD and Aussie US. I'm presuming there might be some form of triangular arbitration between Euro CAD, Aussie CAD, and Aussie US, but I'm not 100% sure if that's the case. But it's not unusual to see grid systems with such high win rates. And the reason being is because generally they take smaller profit targets. So if we take a look at strategy analysis quickly, it'll probably be a negative payoff ratio. Yeah. So you can see the average winning trade is much smaller than the average losing trade. And the reason being for that is because as you get into positions, it will just keep adding throughout a grid system. So if you go into drawdown, it will add, meaning that you generally win a lot of your positions because you just endure the drawdowns, right? So like I say, it's not unusual to see such a high win rate, which is 78% combined. There's not really anything to take away from this. Usually what I do when we're looking at asset allocation, which like I say, is just a split down of the assets that you trade, what I usually look for is kind of patterns between the win rate and the return. Sorry, not the win rate, between the trades, the total trades and the return. So for example, if you have 100 trades on the euro dollar and you've made 5%, but then you have 1,000 trades on pound dollar and you've also made 5% for argument's sake, you would look at that at face value. And if you look at the return, you say, oh, it makes sense to keep both assets, right? 100 trades, 5%, 1,000 trades, 5%. But actually, when you break it down based on return per trade, you go, well, if 100 trades on euro dollar got me 5%, but I had to go through 1,000 trades on GU to also get 5%, your expected value between the two pairs is 10x different. It's majorly different, right? Because you're not taking the same return per trade. So I try to look a little bit deeper than just, oh, this asset is profitable. I try and look, okay, how profitable is it? How well does our edge work on this asset? Is it that your system only works with pound dollar, euro pound, whichever asset it may be? Or does it work across all assets? Now, with VLH, I'm presuming it's run sort of like a portfolio. So there is different strategies running simultaneously. I'm presuming that's the case. Please correct me if I'm wrong. So it's a little bit harder to make that assumption. But generally, you will be able to see whether you have an edge on one asset over the other. With the amount of record that you have, which is like, 4 years now, I would be looking to make some changes if there was any patterns that really stuck out. But to be honest, I don't think there's any issue when it comes to the assets that you're trading. Like I say, if you had 1,000 trades on one and 100 trades on the other, both returning the same, I'd potentially say, why don't you look at scaling out of the asset that you take 1,000 trades on and trying to reallocate that risk, or have a bit more risk distribution towards the asset that you have a higher expected value on. Makes sense to play your better hand, right? In fact, I'll go into the poker analogy in a moment. If we move down slightly, this is always a little bit more difficult with automated traders as well, is because generally, of course, you can put trade blockers in place and you can set EAs to only be active during certain hours, but quite often that can butcher the edge. And you kind of need it to take trades around the clock. And that's kind of the purpose of having automated trading, right? Is that you don't have to lift a finger, you don't have to be at your desk, and it does its own thing. The only thing is here, and remember, this is across a 4-year period, is the EA or the portfolio generally loses money during the American session, right? So during the US session, it's where the least amount of trades have been taken, fair enough, but it loses the majority of money there. Now, you can kind of explain this from a strategy perspective. Perhaps you close the majority of your trades during the European session. Maybe you have kind of a time-based target, and hence why the majority of your return comes in the European session. But there is a massive, massive discrepancy between the European session and the Asian session and the American session. So here's a good example of what I was talking about just. And I just want to preface this with, it does say number of trades, but actually this means trading decisions. So it does count opening a trade and closing a trade as a trade here. Per trade, the European session is far, far, far more profitable. Probably about 15 times more profitable than the Asian session. Maybe not that much, maybe 10 times. Because in 2,000 trades, you've made 71%. In 1,500 trades, you've made 5%. Okay, so the return per trade is dramatically different. Now, should you stop trading the Asian session? Of course not. I'm not saying that. However, Vincenzo, yeah, it's correct. There are different strategies behind it, and somehow the Aussie CAD and Aussie US are the best performing within our strategy attitudes. I mean, they're great pairs to trade. I love both of them. Like I say, Aussie CAD I think has a very good mean reverting nature, and Aussie US is kind of, it feels like you're trading euro dollar or pound dollar. Like it kind of has that stability of those pairs, but it's just that little bit more aggressive. So I kind of like Aussie dollar. How we doing, Rob? It's good to see you too, dude. M8 said, or mate said, hello, do I need to pay every month if I get an allocation? Yeah, you pay for access to the infrastructure that we give you. So yeah, your subscription is forever, basically. Back to what I was saying. The expected value between the different trading sessions is by far, well, what's the saying? I can't remember what the saying is. My mind's going blank. But it's extremely different between the European session and the rest of the sessions. Now, like I say, does it mean you should stop trading those sessions? Of course not. And the issue with this metric specifically here is we don't know whether it's you opening trades or closing trades in those times. So it's hard to ascertain what you should do with this information. But just know that the European session is generally where you make the majority of your money. So when closing trades or leaving them to run, for example, you can rest assured during the European session that they're likely to not be winning trades, but that's where you generate the majority of your return. It's more efficient. Exactly that. Perfect language to use. More efficient. Now, if we move down, one of my favorite metrics, and this goes for both discretionary and algorithmic traders as well. I think it's a phenomenal metric for any trader to track, although not a lot of traders do, which is super, super frustrating for me, is their return distribution by day of the week. And the reason that I believe this is one of the most important metrics that you should track is because there is so much variation that can happen in both a strategy perspective and your own routine or your own life that can affect this variable. I always tell the same stories when I go over this metric. And everything that I say is from real conversations that I've had with traders whilst working at Darwinex. I spend a lot of time on sessions with traders, reviewing Darwins, giving feedback, analyzing their data. I do this time and time again, and I've done it with hundreds, if not thousands of Darwins, right? And there's certain patterns that I notice on this chart that are super, super interesting. And there's two that I kind of use regularly as an example. And number one, this is kind of more towards the discretionary side of things. But these are real conversations I've had with people. There was a conversation that I had where somebody's Friday performance was really poor compared to the rest of the week. They were a super profitable trader, but their Friday was really, really, really bad. I can't obviously name the Darwin because they were a trader with us. But it looked kind of similar to this, although the Friday was like even worse. And we were trying to identify somewhere within the chart, somewhere within the strategy as to why Fridays didn't work. And we were getting to the point where we were just like, it might just make sense to not trade Fridays because clearly your edge is underperforming. But before we made that decision, I kind of took a step back and I said, okay, well, let's talk about your Fridays. What do you do? How do you go about your trading on a Friday? Is there any different things that you do on a Friday that you don't do on Mondays, Wednesdays, Thursdays, Tuesdays? Is there anything that's Friday specific? And after a long conversation about that question, we drilled it down to the fact that this trader would finish work. They were a great trader. They were a swing trader. They let their positions run. On a Friday, they finished early because they were in construction or building in the building industry. And what would happen is they would finish early on a Friday. They would go down to the pub with their friends. The markets were still open. They would start having a few drinks and they would start mismanaging their trades, not closing their trades, opening stupid trades because they were a little bit drunk. Okay. And that was a problem because it was directly affecting the trader's performance. And they didn't realize it, which is the biggest issue. And the reason that's an issue is because it's not strategy specific. The strategy was fine. The strategy was profitable even on a Friday. It wasn't as good as the other days, but it was still profitable. But that trader was directly damaging his performance because he was going to the pub, because he was having a drink, because he was then trading, and he didn't even realize it. So all I said was, well, you know what you need to do. Just not go on your phone when you're at the pub. It's simple. Okay. Because you're doing stupid things that's directly affecting your record and directly affecting your ability to progress as a trader. Another one that I think is really interesting, doesn't affect everybody, but some people may have this. I was speaking to somebody before whose Wednesday performance was really poor comparative to the rest of the days. They were still profitable on the Wednesday, but like I say, it was a lot lower than their other days. And again, we had sort of a similar conversation. Well, is it strategy specific? What would be different on a Wednesday when it comes to your strategy as opposed to the other days? And we couldn't really find an answer. So we dug deeper into their life. And what it turned out to be, or at least what we believed it was Wednesday was the only day of the week that this trader took their child to school. The only day of the week. The other days they didn't. So they got to their desk. They were trading like normal. They were doing their work. They were in their routine. When a Wednesday came, they were trading the European Open and the London Open, but then they were rushing to get out the door to take their child to school. So they were getting up, making breakfast, making sure the kids were ready for school. They were doing the school run, all whilst trading. So instead of being at the desk, trading from the desk, doing it from the phone in the car, trying to rush these decisions and just having a lack of clarity. And we put it down to that because we couldn't find a hole in the strategy. We couldn't find anything strategy specific as to why it wouldn't work. But then when we looked at all of the trades, there was kind of a differential in the decision making, in the trade management. In the trades that were taken, we were looking at the journal and we could see there were trades that didn't fit the plan but were took, and they were only took on the Wednesdays. And it seemed to be like it was a rush decision, or it was kind of oh yeah, I need to get in this trade because I'm heading out the door now. Jason said, with the day of the week distribution, does it show the result of trades opened on a specific day versus closed? So if you mentioned, might have missed it. No, it's closed P&L, I believe. Yeah. The accumulated return generated by the Darwin in each day. So it's a closing of the trade, which again makes it a little bit more difficult for swing traders, or if you're holding trades for multiple days. But if you're a day trader or a scalper and you're in and out of positions within the same day, of course, it kind of means the same thing anyway. Vincenzo said Friday night at closing time is also the most dangerous moment of the week, considering spreads and volatility. And automated system trading with stop loss or trailing stop loss often get trades killed. Yeah, 100%. That's why that's the only reason I'm not a fan of trading in liquid assets like exotic pairs and stuff. Like I think I had a was it a Euro Swissy trade? On my grid, I had a Euro Swiss trade. Now, luckily, that doesn't have a stop because it is a grid system. But yeah, the spread went wild. It was like 50, 60, 70 pips. I can't remember off the top of my head. And this was only a few weeks ago. But it's that Friday night rollover where you're closing for the weekend. It can get pretty dangerous. What I sometimes do with that, which, is kind of bad practice, but you can remove your stop and then just reapply it as soon as the market opens. Problem is if there's a big gap, if something happens over the weekend, then it can wipe your account out. Maybe not wipe your account out, but if you're trading with size, it might. But yeah, it's definitely something to be aware of, like spreads and volatility. Even, it's not reflective of real market movements. The market hasn't dumped 100 points going into the close, but it looks as if it has, as if you look at your P&L, right? Jay said more handy for specific session traders than in that case. Yeah, 100%. Unless you follow the same routine, right? You can still ascertain a pattern from it. For example, if you're a swing trader and you usually close trades by end of the week, you can kind of see how that's working because you can see where they return the most, where they underperform. So if their Fridays are low, but they're closing trades on Friday and their Thursdays are higher, you might be able to sort of see, okay, well, if I go through my previous trade, should I have closed them on a Thursday? There's still things that you can do, but it is a little bit more difficult. Exactly. Swing traders might not get too much information from this specific metric, which is the same with every variable that we look at, right? There's certain variables that will suit a specific style of trading over others. That's why we look at so many, because out of I don't even know how many metrics we look at in these sessions and how many things we go over, but out of all of them, there might just be one thing that you take away and go, actually, that can improve my trading by, 2-3x. We'll get onto maximum excursions in a minute, which I think, again, is a metric every trader should take a look at because it can genuinely turn a non-profitable or a break-even strategy into a winning strategy without having to change anything strategy specific. I believe that is one of the only universal metrics that applies to every single trader and every single strategy. But yeah, for sure, there's certain metrics and certain variables that are more suited towards kind of improving a specific strategy, if that makes sense. So quick look over the base statistics. There's almost 2,500 trades executed. So a fantastic sample size. Again, it's distributed over 4 years. So when we're talking about this record, we can say things kind of like matter of fact, right? We know this is the pattern of trading over the past few years. It's not as if we have a 3 or 4 month old track record where we're like, do we know that this is how the trade is going to continue moving forward? So it's really refreshing to have such a long record that we can say with so much trades, so much trading data, that we can, kind of say with conviction where there's something that might need to be changed. Vincenzo said, one solution we're experimenting right now is to stop opening new sequences on Friday morning. Okay, so yeah, interesting you say that. I used to run kind of a portfolio of grid strategies, and what I would do is this was more to counteract the downside, so to counteract drawdown risk. I would let it run from like I'd get up at 6, 7 in the morning. I would start it. I found the sweet spot was like 6:45. Because generally the way that my system worked at the time was that's where we got the best entry for the day from a directional perspective. Because if it's gridding, obviously, of course, you kind of want the direction to be right. So we'd enable it just before 7 a.m. UK time, and we'd run it till about midday. If it started hitting targets, which generally 60-70% of them did, I'd start shutting them off for the day and switching it off. I'd be more aggressive on a Friday. I'd shut it off at like 10, 11 a.m. And what that meant was generally you weren't taking too much risk over into the next day or into the next week, which is similar to what you're talking about now, is being able to close off that risk before the new week. Of course, it can lower your return slightly, but it also lowers your exposure generally. So your value at risk can increase. That it's not a bad thing to do, right? But it's kind of fail-safing, or putting a fail-safe in place when it comes to grid death spirals, which are a real risk, no matter how you trade. But yeah, it's a super interesting concept. Like I say, I used to shut off trades midday, and if my drawdown got too big in the carryover risk anyway, I just keep them shut off for the following day until my trades manage to work out of drawdown before I re-enable the portfolio. So something super interesting that you're looking at there. Interestingly, you've only got 16.5% long exposure, basically meaning that you're short the majority of the time. Don't know why that is. Maybe over the past 4 years, it's just that maybe it's just that the market's been down for the past 4 years, so you've been shorting everything. But that's one of the lowest long exposures I've ever seen from a trader. Vincenzo said, along the 4 years, we adapted the strategies 2 or 3 times per year, trying to digest all market changes. Yeah, I mean, that's what you gotta. This is what out of sample data is for, right? Is being able to test your strategy in different conditions and understanding, okay, well, overall it's okay, but where does it underperform, and can we make a change to kind of facilitate that? Again, not to bring it back to myself, it seems like I'm doing that all of this session, but my portfolio on the back test that I have for the past 8 years, there's a couple of years where it really underperformed, and you know, had single digit year return for the year, whereas other years it did 20-30%, which is fantastic, right? And overall it's great. But if you look at those individual years in isolation, you'd go, well, 3% for this year or 4% for this year. So what I'm trying to do now is build a few strategies that underperform when my portfolio overperforms, but outperforms when my portfolio underperforms. So I can try and kind of smooth that curve and smooth those years. I'd rather have, you know, 15% years than 3%, 30%. Like it's about getting that, in my opinion, the smoothest portfolio that you possibly can, the smoothest systems you possibly can. There's no point in having a portfolio that returns 90% of its yield in 1 year and the rest of the years it's pretty useless, right? Might look good on paper when you're looking at overall. Going back to what Vincenzo says, looking at adapting the strategy to all different sort of market conditions and market changes. It's why it's so important to test your system on out of sample data. Again, if you're learning a strategy from somebody, or you've done a course and you've learned a pattern, don't just go back on TradingView and backtest this pattern and go, oh yeah, great, it's done, you know, 20% over the past 12 months. Take a look at different years. Take a look at different market regimes. Take a look when interest rates are positive, negative, flat, like all these different things. Take a look at when Trump gets in presidency. Take a look at when Biden's in presidency. Like all these different changes, you need to understand how your systems adapt and how your systems perform in all of these different environments. So important. And that's why you'll see traders, and I was a victim of doing this, every few years or maybe even less time, a trader will change their system. And it's because the system kind of gets outdated, and it's not the strategy's fault. It's just that strategy is very specifically designed to perform in a specific market condition. And it's very easy to see that when you're using automated trading, because you can run a back test. You can run it in sample and out of sample, and you can do that sometimes in minutes, if not hours, right? Whereas there's a lot of manual work to do that if you're a discretionary trader. Anyway, getting off topic there. 2.5 trades frequency per day, so quite inactive for a grid system, which is good because you're not peppering too much, keeping that kind of exposure nice and low. 78% combined win rate, which is great. Profit factor of 1.45, so fantastic. Generally 1.5 and above is considered good. Anything above 2 is considered great. However, I always find that when you're combining strategies, and again, I don't know if anybody else has found this as well, like when you're combining strategies, generally the profit factor looks a little bit lower anyway. Same with the sharp. I don't know why it just does. Profit factor is basically a sum of all your wins, sum of all your losses, and divided by them. But if you have multiple strategies that all operate completely differently, you kind of skew up those figures anyway. So I don't always think it's 100% accurate. So 1.45 is still fantastic. Perfect example of this, what I'm talking about there, is SYO. So SYO, I think, is 8-year track record. 2016. So yeah, well, I mean, started December 2016. So yeah, like a 7-8 year track record. If we take a look at, let's go on to 0, so we can see the actual metric I'm talking about. So you can see fantastic equity curve, like our second most capitalized Darwin, just a phenomenal trader. Also an algo trader. Also has it in a portfolio because he has multiple strategies running on multiple assets. But then you look at the profit factor and it's 1.23. Now, would you not invest in that trader because the profit factor is low? But then when we look at their return, their drawdown, the stability, it's all fantastic, right? So I don't always put too much emphasis on the profit factor, especially if the trader has a high Sharpe ratio, which if we just quickly jump back over here, see the Sharpe is 1.28. So again, a Sharpe above 1 is considered good. 1.5 is considered great. 2 is considered fantastic. Anything above like 2 or anything above 2.53, I kind of think either you're lying or you don't have enough data, basically. But Sharpe is just a measure of your return and volatility of your return. Jay said, very nice expectancy here. Whilst on the topic, from your experience, does the Darwinex risk engine tend to like higher win rate, low risk to reward combos to say medium win rate, risk to reward combos, or low? There's no kind of favoritism. If the trader is profitable, generally the risk engine will work well with it. If the trader's exposure and risk is kind of all over the place, then that's generally what the risk engine doesn't like. I think I can hear my son coming up the stairs, so bear with me because I'm going to have to send him back downstairs. Give me 2 seconds. Sorry about that, guys. Yes, wait. The risk engine. There is no kind of preference. It doesn't like a specific strategy over another strategy. It kind of doesn't really care, right? It only looks at your exposure and how much risk you take. That is all it's bothered about. Your job as the trader is to design and trade the strategy. The risk engine's job is to just make sure that your exposure is consistent throughout. There's no real there's no real preference to how you trade. Okay. Average winning trade, like we've already looked at, is 0.13, whereas average losing trade is 0.32. So there is a negative payoff ratio. Now, that's okay. And I also have systems that are like that, and they are fantastic. You just have to ensure that your win rate does not slip. Again, which is why it's so important to run out of sample data so that you know in different market conditions, can I withstand this win rate? Because if you're playing with a win rate of 75, 80, 85%, it sounds high, but of course there's traders that do it because if you have a 0.1 risk to reward, it's likely that you're gonna win a lot more than you lose. You'll just lose a lot more than you win in terms of dollar amounts on those trades. So having a negative payoff ratio doesn't really concern me if you can withstand and withhold that high win rate, which of course, again, this is over 2,500 trades, almost over 4 years. It's clear that you can. And I'm sure you've done testing in out of sample data to understand, okay, my win rate in this period was X, my win rate in this period was Y, my win rate here was Z, and then kind of calculating the variance between those. Average losing trade duration is 3 days, 3.5 days. Average winning trade is just under a day, given a low duration ratio of 0.25. Again, this is kind of a classic grid / martingale / pivot pyramid trade duration ratio. Like you can usually tell because, again, you'll be targeting smaller amounts on your winners. Therefore, it's quicker to kind of get there. Whereas if you go into drawdown, you'll sit in those trades and you'll wait for the system to clip again and clip again and clip again and work out of the drawdown. So generally, your drawdowns or your losing trades do take longer to fulfill than your winning trades. Again, it's not an issue when you know, and this is why I asked at the beginning, is it a grid trading system? When you know that and you understand that, of course, this isn't of concern because you know that's the way that the strategy's sort of designed. But if you're a trader who, again, if you're just a discretionary trader and you have a FIFO system, which just means first in, first out, so you execute one trade and then you close that trade before you open another position, for example. If you have a negative duration ratio or a lower duration ratio, you've got to ask yourself why. Is it your strategy that gives you the low duration ratio? It's like, especially if you have a positive risk to reward. So if you have a 2-to-1, 3-to-1, 4-to-1 risk to reward, for example, generally you should have a positive duration ratio. If not, it can be an early sign that you have some form of psychological issue or some form of trade management issue. And the reason I say that is because generally what we see, or what you should see, is a higher winning trade duration because you're allowing your winners to play out. You're not getting involved. You're not micromanaging your positions. You set a target, you let the trade play, and you let the trade move to your target. The average losing trade should be low because as soon as you get the sign that your trade is going to be a loser, you should be able to step in, cut that trade, and move on. Not a lot of traders can do that. That's kind of what separates the pros from the non-pros, in my opinion, is the ability to step in, cut the trade, rather than just holding onto it and hoping it turns into a winning trade. But again, in this specific example, it doesn't concern me because I know that's the way that the strategy is designed. We're not going to look at this chart because I don't think it's specifically relevant if you're grid trading. But generally what this does is the left-hand side, this axis shows how long you were in a trade for, and the bottom axis shows the return of trades in pip calculation. So on the right-hand side is positive return, on the left-hand side is a negative return. What I like to do with this is figure out where your expected value is higher and lower. Of course, for a swing trader, you would expect the longer that they're in a position, so the higher up on the green side, the higher their expected value would be, because there's no point. That is exactly what swing trading is, right? Whereas a scalper who's generally in and out of the market pretty quick, you would expect that they have a highest expected value the less time that they're in the market. For example, if you take a scalp and then you end up holding it for 3 days, you would probably think that that's a lower expected value because it's outside of the norm of that strategy. It's not following what they usually do, and therefore it has a lower expected value because, well, you don't know if it's going to play out or not. Because it's a grid system, you can see that it's kind of congested down here. So yeah, the less time that you're in a trade, the odds are it's going to make money, right? But it's very difficult because if you're in 5 trades and it's gridded in, that's 5 trades that are going to show up on here. It's hard to kind of ascertain any true information from it. So we'll move on from that one for now. Again, another kind of telltale sign of a grid system. Sounds like I've been bashing grid systems this whole session. Genuinely, I'm not. I am a fan of, if used correctly, which it's clear that you are. I'm just saying the telltale signs when I can tell if somebody trades with grid or martingale. And the reason I've learned this is because so many people would come to me and lie about it. And I'd say, do you grid? Do you martingale? They would say no. And I'd look at their record and I'd be like, I can tell you do. But it's a massive downside on trades comparative to the upside. So you can see the worst negative excursion to the downside is like what, 3, almost 4x the best positive excursion, meaning the most a trade has moved against VLH is 11% or 11.3%, whereas the best it's run for VLH, yeah, not LVH, is 3.56%. Okay. That is okay. Again, we know it's a grid system, so we know this happens. But generally, what I like to do with this, I think this is the best metric for any trader to track, period, regardless of whether you're algorithmic, regardless of whether you're discretionary. Every trader should invest a significant amount of time in deep diving into their maximum excursions. The problem with this chart is that you don't see what happens outside of the trade. So this only measures what happens within the position when you're in the market, which, you know, it's all it can do because it can't tell what you was going to do after. You should be tracking this in a journal. Again, a little bit more hard, a little bit more difficult if you're a scalper or if you're an algorithmic trader. But again, with the algorithms, you can kind of back test it again. You can run different simulations. But if you're a discretionary trader, you should go through your journal. If you don't have your maximum favorable excursion, maximum adverse excursions tracked, you should track them. So your maximum adverse or negative excursion is how far your trades move against you. The reason that's so important is because if we know on average how far your winning trades move against you, is you can do one of two things. You can try and tighten your stop loss. So if your average negative excursion is 30 pips, but you're risking 100 pips, you know that you're risking 70 pips too much on that trade. So you can make your stop loss a lot smaller, henceforth increasing your risk to reward on positions, which, like I say at the beginning, I mentioned this and I said it can turn a non-profitable or a break-even trader into a winning trader purely based on your risk to reward without any real work on the strategy, without changing anything from an execution perspective. The other thing that you can do is if you find that the minimum any trade has gone against you is 10 pips, again, you can move your entries lower. If you know that your trades go against you 10 pips on average before they turn and become winning trades, well, guess what? You should probably move your entry. Now, of course, you might miss some trades, and that's why you need to go through, track it all, measure it all, run simulations. What would or what's known in algorithmic world as what ifs. Okay, so what if my entries were 10 pips lower or higher? What if I had a 50 pip stop instead of a 100 pip stop? Run these tests because it can pay massive, massive dividends. Stop spending time on back testing softwares and running your trades, journaling your trades and giving yourself a pat on the back for doing another 3 months of journaling. Of back testing. Go through the trades you already have and test different scenarios. How can you optimize what you have? Again, this metric can change your life as a trader, in my opinion. On the flip side to that, the maximum positive excursion is another great metric because you know how far an average trades move for you. So you can understand if you're not holding on to trades for long enough. Okay, so, and this is where you need to measure outside of the trade. So this is where a little bit of manual input is needed too. If you're an algorithmic trader, again, you can just run a back test or a simulation extending your targets. It's pretty easy to do. If you're a discretionary trader, again, it's going to take some work in your journal, but go through how far did the trades actually move in my direction? Because if your target's 50 pips, but on average, you're catching trades that are moving 100 pips, well, guess what? You can double your targets and make more money. That's what it's all about, right? You want to take the best trades that you possibly can and you want to squeeze the most out of them. You're only going to know these numbers if you track them and if you look for them. But again, if you're taking 50 pip TPs, but the trades on average are going 100 pips, well, you're not targeting enough. You're getting great trades in, but you're leaving a lot on the table. And this is why I say you need to track it outside of Darwinex or outside of any trading journal you have, because you will know by looking at a chart. Okay, that is how far it ran. And I'm not saying that you should put 1,000 pips as your maximum favorable excursion because you entered a trade and then 3 months later it's continued to move up. If you don't hold trades for 3 months, then don't put that down as your excursion. What I used to do as kind of a general rule of thumb is I'd run it till the next swing high or the next swing low was created with the next major pullback, and I'd be like, okay, that's how far I should measure it to. The first real kind of pullback on the trade against my trade is where would be your maximum favorable excursion. And you might be surprised at how much you're leaving on the table. I know I've been whenever I've ran this test in my own journals. What's great with this is it can really help put it into perspective when you're trying to manage trades. So if you're in a trade and you're getting shaky leg syndrome because you're up, you're up in profit and you're worried about giving it all back and you're up 30 pips, but your target's 100. If you have the data to say the average that your trades move for you is 100 pips, well, guess what? You're going to feel so much more relaxed in the moment. You're going to be less hesitant, about giving your profit back, and you're going to be more free to let the market do its thing. Again, it's one of the reasons why I do so much testing on my algos, because I want to let them play out. I don't want to feel like I need to be involved and need to close trades and need to extend stops or targets. I just want to let them do their thing. PXLou says, I personally use fixed risk to reward and it works good for me. Yeah, this is the thing, right? You got to find what works for you. But there's always an optimization that can be implemented. Like you can always look for things to improve your strategy. The problem that you have is don't run before you can walk. There's so much testing. Like if you have a profitable strategy, before you make any real amendments, you've got to know the expectancy of these changes that you're making. Is it actually going to improve what you do on a day-to-day basis, or is it not? Are you overfitting for a specific period? Again, why it's so important to run out of sample data. Because we could go, oh, for the past, for 2025, my maximum favorable excursion has been 100 pips. So I'm going to increase my targets. But if we run that in 2020, 2015, 2021, you might find that the maximum favorable excursion was only 50 pips. So you're being kind of blindsided by recency bias, looking at just one sample of data. You need to understand the average over multiple data sets. PX Lou said, Vincenzo said, fully agree, which is great to hear. PX Lou said, also, I would always note down your maximum favorite excursion with percentage or some kind of risk to reward metric as well. Yeah, 100%. Candle sizes change over the years and you don't want to get effed up years later. 100%. I'm not a massive fan of doing things in pips or dollar gains or anything like that. I'm always more of a fan in percentage. It's a little bit more difficult doing it in percentages. If you're trading multiple assets, like it is easier to do it in pips, but what I used to do is I used to track it in both. So I would, I'm old school, right? I do everything on Notion or spreadsheets from my data analyst days, right? I don't use or really like automated journals too much. Works for some people, but it doesn't for me. It makes me lazy. But what I would do is I would have my maximum favorable excursion, my maximum adverse excursion. I would have it in pips. I would then have some formulas to recalibrate that into percentages based on current quote price of the asset. Technical to set up, but that's what worked for me. But yeah, it's great point, PX Lou. Let's take a look at the VAR. Quite bouncy, which again is to be expected by a grid system. And the reason I say that is purely based on the fact that you can't accurately say what the exposure is going to be moving forward, because one trade in a grid system might have one trade, and then your next trade might have 10 trades, all increasing in size. So it's difficult to say with conviction moving forward that the exposure is going to remain steady. Okay. So what you'll see with this is there's probably a lot of variance on the risk multiplier, and can sometimes probably trip you up, because you're as you work out of the grid positions, as you start making profit, if your VAR's been recently damaged, it might be less than what it would have been a couple of weeks ago. But it's not a massive issue. There's no massive spikes really, apart from this drop here and this increase here. So I wouldn't be too concerned about that, but it's something to be aware of. The risk engine doesn't really care about a high or low value at risk. It cares about consistency and stability. So like this, for example, even though it's dropping, it's doing it quite a stable, consistent way, right? So even that is fine. The only time I would say that there's an issue with this is what we've seen over the years. And bear in mind, Darwinex has been around since 2013. If a trader is above 30% value at risk, there is an exponential increase in chance or increase in probability that that trader will blow up their account. It's not to say it's guaranteed, and it's not to say it's guaranteed that somebody under 30% of value at risk won't blow up their account. But we see an exponential curve of people who do blow their accounts or go through some nasty significant drawdown if their VAR is above 30%. So that's something to keep to just bear in mind. I'm just going to check an email because something's just come through. Okay, that's fine. I have to finish up in 10 minutes because I have another call. Dalvin Tang said, hi, how are we doing? Welcome to the session. It's great to have you here. What is causing my risk ratio to keep dropping as my strategy is more a swing trader, which will take a longer time? Does it affect the risk ratio? So I'm presuming that you're talking about your risk multiplier. Yes, the holding time can affect your value at risk, which in turn would affect your risk multiplier. There are self-balancing mechanisms. So when your VAR increases, your risk multiplier decreases, and vice versa. It takes into account a few different things. So how long you hold trades, how many trades you execute, the volatility of the asset, which, as a swing trader, if the asset volatility is fluctuating, so if the VIX is increasing, of course, the volatility in general in the market is increasing. If you're holding trades for a longer period of time, yes, all of these things can affect your value at risk, which in turn would affect your risk ratio. Also, the biggest thing is your position sizing. Okay, so if you're increasing your position sizing, your value at risk generally will increase. Your risk multiplier will generally decrease. So there's a few different things there that will affect that, but I wouldn't be too concerned unless you're dropping from a 10x to a 1x overnight. Then of course that's something that we could potentially look at, but I wouldn't be too concerned about that. Now, what we usually do at this point, but I'm concerned I only have an extra 5 or 10 minutes, is we go over the metrics on Darwinex.com as well, because we do have some different metrics to take a look at. But what I would do is I'll go through a couple of them and kind of tell you how to get here so that you can take a look for yourself. So you can view, if you have a Darwinex Zero account, you can view your Darwinex Zero Darwin on Darwinex.com as well. All you would have to do is log into Darwinex.com. You should be able to do that with your Zero username and password anyway. And at that point, you can find your way to a Darwin page by going through the Hall of Fame or through any kind of leaderboard that we have. Or you can just go Darwinex.com/Darwin/ four ticker Darwin, and then put a hashtag at the end. It will, for some reason, the hashtag makes it work. Don't ask me why. I didn't build the internet. So you can view your Zero Darwins on here as well if you wanted to access this information. So we track different things and we call them investable attributes. For example, you have a market correlation score, which scores how efficiently you trade both sides of the market. You can see that VLH is scored 8.7 out of 10, which is relatively high. We usually see the majority of traders are quite high anyway. The performance isn't usually skewed to a market direction unless you're a long only stock and ETFs trader, for example. At that point, your performance is directly benefited by the market being going up or being in a bull market, and therefore you're going to overperform during that period and underperform during bear markets or periods of slow economic growth. So you generally would have a low market correlation score. You might be able to survive. You might be able to hedge against the volatility that the S&P goes through, for example, by trading individual stocks. But generally, you're going to struggle to perform the same way that you would when the market is just going up and up and up. We have a few of the same metrics, for example, risk stability, which is your value at risk chart. Risk adjustment shows how often that the risk engines intervened in your trades, if at all. Open and close strategy, which are really interesting metrics. It shows if you would benefit by getting in the market earlier or later on your trades, or closing your trades earlier or later, which works super, super well if you're cross-referencing that metric with your maximum favorable and maximum adverse excursions. They work hand in hand together, especially when looking at, do I need to run my trades for longer? Am I leaving money on the table? Because if your closing strategy is saying, yep, you would benefit by holding your trades by 50% longer in terms of time duration, and then your maximum favorable excursion is also telling you that you're closing your trades too early, guess what? You got something to improve on. We've got a few more metrics. All of these are available on Darwinex Zero. Performance is a Monte Carlo test. So this is just a Monte Carlo simulation comparing your strategy to 10,000 random strategies, all operating with the same risk. And you can see VLH at the moment is on the 88.54th percentile of that chart, meaning that they've outperformed 8,853 other simulation tests using the same risk but different strategies, essentially, which is fantastic. And then capacity is a really, really interesting one. And this is one that a lot of traders come to Darwinex for when they're analyzing their Zero Darwin. And it's because they want to understand what their alpha cap is or what their max investment is. So essentially, this shows how much investment you can take in as a trader or in your Darwin before your edge effectively blows up. And if you're not aware, every strategy, every trader has an alpha cap. Not every strategy can be scaled to $100 million in terms of AUM. And the reason being is because, well, you have liquidity issues. You have execution issues, slippage, all of these different things that come into play when you're handling large size. This is why, if you're a hedge fund managing billions of dollars, they're not going to be sat executing the same way that we would with $1,000 account or a $10,000 account, because we can be pretty nimble getting in and out of markets. Even thinner markets, we can get in and out of pretty easily. Whereas if you have multi-millions, if not billions of dollars to execute, generally you're going to find it very, very difficult for the other side of the market to be able to absorb that sort of liquidity going in. Anyway, with that out of the way, we score your capacity again out of 10. 9.4 tells me that you have a high capacity, which means you should be able to handle quite a large investment. Just going to click this over to all time to show all time. So this is an interesting one. So this is the divergence. And this shows how sensitive your Darwin is to slippage. So you can see currently on September the 1st, which was this Monday, I think it updates every Monday, this chart, your Darwin was up 68.61%. But if your investors were following from the start and getting slipped 2 pips on every trade, they would only be up 22.75%, which is a massive difference, right? And so we have to display this. We have to cap your strategy because it's our asset management license that's on the line when we take in investor capital for you. And if we're advertising your strategy at making 68% over the past 4 years, but your investors are only up 22%, guess what happens to us? A, we lose all of our investors, but B, we could get done from a regulatory perspective. So we have to measure this and we have to cap strategies where they can't take any more capital. So what we do is we measure the divergent sensitivity. We find this by looking at the toxicity flow of your orders and understanding the liquidity at the time of execution and how much capital could be input into the market using your entries. From that gives us a divergent sensitivity. And from that, we calculate how much investment you can handle as a trader. So if we scroll down, you can see the max estimated investment here. What is causing the gap? So that's the gap is slippage, right? So this is kind of a simulation on what would happen if the investor was slipped by 2 pips. So every time you execute, the investor's getting 2 pips worse of an entry than you are. That's why there's such a big gap. There's going to be gaps for every single trader, like because of the slippage or because of the simulated slippage, I would say. But currently, your system can manage 211 million before this begins to happen, before this begins to be a problem, which is insane, right? There's literally no issue with 200 million. If it's like 5 million, 2 million, 1 million, then I sometimes say maybe it's worth investing a little bit of time to figuring out why it's so low and if there's anything that you can do to increase it. Unfortunately, there's no answer I can give to say, oh yeah, implement this and it will change for you. But if you're trading with like a 2-pip stop on, Aussie Swiss, a super exotic pair, you're in and out of the market in seconds. Of course, trying to do that with $1 billion or 100 million or 10 million even is going to be extremely difficult, right? And even though you might be making profit on a small account, a large account will not be able to execute and keep up with that frequency. And therefore, they'll have a really low alpha cap. Whereas somebody like yourself who's getting in, letting the market breathe, holding trades for a day or up to 3 days, probably doing it with fairly low size and just letting it go out. Projected risk versus slippage, essentially, yeah, essentially. But 211 million, I would never be concerned. Unless you tell me you've got an investor with 200 million ready to step up, I'd be like, well, it is what it is. If you get to 211 million, then more power to you. But at that kind of number, I just wouldn't be concerned at all. Like I say, if it's anything under 10 million, then yeah, of course, at some point that might become an issue. But again, I sort of think if you're starting out as a trader and you're worrying about your alpha cap, but you don't even know if you've got a strategy that works in different market cycles, different conditions, then you're focusing on kind of the wrong thing. Where you are now, 200 million, I mean, that's of course life-changing if you manage to get your AUM to 200 mil. But I wouldn't be concerned. I'd be starting to get concerned when you've filled 75% of that, right? So if you get to like 150 million, 160 million, I'd be going, right, we need to think about increasing this. But at that point, you're probably rolling in cash that you're not even bothered. You probably don't want any more AUM. But anyway, guys, I'm going to have to call it an end of the session now because I have another call in a few minutes. and I've got a couple of things that I need to do between now and that call. And we've ran over by 10 minutes anyway, but I kind of like running over on these sessions. I end up rambling about random things. I just want to say, Vincenzo, massive thank you for jumping on and allowing us to go through your Darwin. We will be having a chat. I don't know when you booked in a call. I'll have a look. I'll have a look at my calendar, but whenever you did, it'll be fine. We'll jump on and have a chat in private. Friday. There we go. Perfect. So yeah, I'll speak to you on Friday, but this is great because I pretty much know everything about your trading now when we come into the session on Friday. And so yeah, guys, thank you for your time today, and thanks for Vincenzo as well. Roman, thank you. Pleasure, guys. It's always great to jump on and have a chat with you all. We'll be back tomorrow at 4 p.m. to do the Darwin explanation session. I did want to start Darwinex TV today, but I've had so much on today. I haven't been able to plan it out properly and to just come on. But I'm thinking maybe tomorrow, if I have some free time, I think I have a call at 3 o'clock. So might not be able to jump on earlier, but I might be able to stay on a little bit later, and we can just kind of have a chat and have a chill out talk, all things Darwinex, and then go into the presentation for the Darwin explanation. So with that, guys, I'm going to leave you. JCid, as always, go get some sleep, dude. I know it's going to be late for you right now, so go get some beauty sleep. For the rest of you guys, I hope you all have a fantastic evening, afternoon, or morning, depending on where you are in the world. Like I say, we'll be back at 4 p.m. UK time tomorrow for the Darwin explanation session, which is a great way to learn more about the risk engine, value at risk, and the risk multiplier. So guys, I will see you all there. Have a fantastic rest of your day. Peace out.